Hello everyone, today is Friday, May 21st, 2021. My name is Evan. Welcome back to our weekly stock market analysis video. If this is your first time catching one of these videos and tuning in, thanks for joining us. Thanks for tuning in and checking out what's going on here. We break our analysis up into two parts in these videos. First part, we look at everything that went on this week in markets. That includes things like correlation and volatility, market internals, sector performance, credit markets, all the good stuff, and sort of pick apart everything that stands out and looks interesting from a fairly sort of macro perspective. And then in part two, we jump into the charts. We look at those longer term trends, try and make sense of where we are and how to best position ourselves looking ahead. So hopefully that sounds good to you. I apologize if I'm a little low energy here, still kind of battling a cold or something that's just really sort of taken me out these past couple of days. So it might be a little more brief in today's video, but hopefully I'll be back feeling good, normal next week. So let's jump into it here. The couple of headlines that really stood out to me. The first was sellers failing to break this market down, and I'm really referring to Tuesday and Wednesday's price action when in regard to this comment. Now, I don't think it was a super sort of slam dunk for the buyers. Like, I don't think we can all just totally rejoice and celebrate and this market's just ready to coast higher. But I do think net on the week here, when we just look at how we started, where we finished, I do think the edge here, even though it was a little bit choppy when we look at some of the numbers, is in the bulls case. We're going to talk about that more in part two when we look at some of the charts. We saw tech starting to lead a little bit and outperform. Again, we're kind of splitting hairs here and looking at a very short-term time frame, but we're starting to see a little more sort of love and rotation maybe for tech. So we'll keep an eye on that. And we also had the US dollar kind of trading back to its year-to-date lows, and more on that later in this video as well. So if we go by the numbers here, you can see it was a pretty mixed week. In fact, mostly negative from the surface numbers here. So if we look at equity market performance, right-hand column here, you can see three out of the major four indices here for the US were in the red. Nasdaq 100, only thing in the green here slightly. All the numbers here pretty minor, pretty small sort of changes on the week. World stocks still doing pretty well there, and we're starting to see that continue to, maybe kick up a little bit here as world stocks continue to sort of outperform a little bit. You can kind of see that on the 1 month numbers, what's working over the past 1 month. You see only the Dow and ACWX here are in the green. So those are the top level market cap weighted indices. If we go under the hood a little bit and look at some market internals, you can see that it was a more positive picture. So we have in the first row the NYSE net 52-week highs minus lows. You can see we had 542 net 52-week highs here for the NYSE this week. That's a pretty solid number. We're slowing down our pace, so we're not at the 4-digit 1,000 plus per week like we were hitting a few weeks ago, but we're still in positive territory. We're still heading in the right direction. So that is encouraging, but we're going to want to keep an eye on that as the rate of change is slowing. If we look at our second row here, cumulative AD line, you can see 650 on the week. Again, not bad, positive, not too strong, but it's slowing down in its rate of change perhaps, but it's still in the right direction. Percentage of stocks over 20 SMA in the S&P 500 is down to 54%, so a much more mild, sort of in the middle of the range number. If we look at the NYSE 52-week highs minus lows in a cumulative sort of summed up sense over the past 30 days, you can see this is what the trend now looks like. So we were sort of just coasting up, very nice, clear, orderly uptrend, and now we have sort of leveled off just a little bit. Again, we're still heading in the right direction, so let's not get too into the weeds on this just yet. I think net here is still a positive, but we do want to pay attention to it. If we start to see this begin to trend down and top out and head lower, that's where I get a lot more concerned about this market. Hasn't happened yet, so let's just keep an eye out for that perspective. Sector performance, you can see it was pretty mixed on the week. So we had 5 sectors in the green this week. Real estate at the top, healthcare and utilities. That rounded out the top 3 here on the week. So kind of a curious bunch that was helping kind of support this market. The consumer staples and technology were 4 and 5 slots. And then on the downside, we saw energy kind of pulling back here. Remember, it got that big ramp up last week, or the past couple of weeks. It started to outperform on a relative basis. So now it's playing sort of this rotation game. It's pulling back a little bit. Same with industrials and materials, rounding out the bottom 3. If we look at correlations here, so the couple of things that stand, actually, there's really only one that I guess we'll really hit on in this chart. So these are 10-day correlations, and the standout here are yields. So you can see this is the 10-year yield, and you can see it's a negative 0.95 correlation to the Dow Jones, S&P 500, a little bit less on the Nasdaq. Basically, what this is saying here is this is almost moving lockstep 1 for 1 in the opposite direction, inverse correlation. So basically, as yields are going up, stock market goes down, yields go down, stock market goes up. We're seeing that very tightly correlated right now in terms of the 10-year yield. So let's keep an eye on that. Excuse me, that's a pretty close, tight correlation at this point in time. We had some pretty significant movement in Bitcoin this week, and that has sort of loosened up from everything. In fact, it's kind of decoupled in terms of its movement from everything else, except for, I guess, gold. You could look at this inverse correlation there, but that is kind of the only other thing that really stood out to me on this chart. Dollar seeing some pretty, heavy inverse correlations as well to both commodities, which is what you'd almost always expect, but also to the Russell and ACWX. If we look at volatility, VIX term structure here, so we did climb a bit this week, but nothing too different from what we've been in. We did close with a 20 VIX. I'm not sure if we officially closed over that number. The numbers this data could have been pulled right at the end. Yeah, 20 spot 15. I think that's basically where we closed. So yeah, that is pretty accurate there. And you can see, over that 20 psychological level, but still, off of the highs that we've been trying to get to intra-week. So we'll talk a little bit more about the VIX a little bit later, but not too much else that has really changed from a volatility standpoint. If we go to interest rates and credit, you can see it was pretty just mixed picture here. So we had the 5-year yields up. We had 10 and 30-year down. We saw just a mixed picture with bonds. So really don't have a whole lot much to sort of add or pull away from this sort of table. I think this is more just noise right now. And like we've talked about in our past videos, it seems like, TLT is just kind of carving out a sideways choppy range. And a lot of these sort of shorter durations as well in terms of bonds, kind of in that same picture. If we look at dollar and commodities, so we saw the dollar continue to sell off this week. Again, one of the headlines was the dollar coming back to year-to-date lows. Gold was up and up pretty nicely, and it is sort of where I'd expect it to sort of fail. It is continuing here, so I do give some credit to what the gold bulls are doing right now with GLD. That is, starting to shape up from a broader perspective, broader pattern, so to speak. Silver, a little less so, but still up on the week. Bitcoin getting hammered this week, 24%. Lots of different events going on there. That is sort of freaking out the crypto assets in general, and that is now seeing its 1-month returns go down to almost 40%, and one of the biggest pullbacks we've seen in the past 10 or so months since really the quote-unquote bull market got started for Bitcoin. So one of the biggest pullbacks there, got some volatility. Hopefully everybody's safe in that. Agriculture was up a little bit, crude oil down, natural gas down on the week as well. So if we look at the report card here, we got a solid C for its marks. We had market breadth, which continues to hold up. Credit markets hanging in there as well. Those are the two pros. On the downside, we saw net equity market performance dragging us down. We saw risk sectors not really doing what we'd want them to do, and the vol environment is not giving us that check mark either. Finally, if we look at our two trading systems here, it couldn't be any more different. And, I love when these two systems do something entirely different. And this illustrates right here why timeframes are so important, why approaches to markets are so important. When you're listening to me do analysis, when you're listening to anyone share analysis on YouTube, on Twitter, anywhere, StockTwits, time frame and just how you're approaching the market matters so much. So we have two, historically very profitable trading systems here, and one is basically 100% long and the other one is net short. And so, you could ask yourself, well, one has to be right, one has to be wrong. And doesn't necessarily have to be the case at all, because they're operating in different time frames and they're doing different things. They have different expectations, different hold periods, different position sizes, all that stuff. So again, a little bit of a tangent here, but something that's worth always sort of talking about whenever I can get the excuse to, because it is so important when we think about just all the different ways to approach markets. So Merlin at the top here is our longer term long only system. So it basically can be 0% not invested, or it could be up to 100% long. And right now it's basically just 100% long. Most of the tilt here is to growth and tech. So that is most of what that exposure is. Not all of it, but that is where the far majority is. And you can see it's basically just sitting and patiently sort of following this market to the upside. Lamerick here, much more tactical. It is short this market, 2 positions, got 2 short trades on right now. And that's it. That's what it's got going on. That's what it's looking at. It's trading much shorter term. It's looking at a much tighter picture here in how it operates. So doing something very, very different, but on the short side, put them together and you get a little bit of a balance, right? So if you're allocating, you could think of 50% to both of these trading systems, then you basically have certainly a long tilt here, but you also have that short exposure on hedge, so to speak, with Lamerick at the moment. And again, that's just generally the situations I love the most, because that just the uncorrelated pictures of them is pretty great. So anyway, if you want to learn more about these trading systems, you can head to the link in the top right, take them for a free 14-day free trial, learn more about them and see if they can work for you. And with that, we'll be back in part 2 in just a moment. All right, we're back. We've got WORDEN TC2000 open. We've got our equity market grid we're looking at right now. Shows the S&P 500 in the top left, Nasdaq top right, Russell bottom left, ACWX, which is international stocks, in the bottom right. Price itself is the white dashed lines, and the multicolored dots you see are a custom smart trend filter that we've developed for TC2000. Measures price, volume across time, helps us determine trend and trend strength. If you're a TC2000 user, you can get that on your workstation on our website. Now, if we take a look here at the weekly time frame, that's what we're looking at, a weekly time frame. We've got some things to take note of, and that started last week in a couple of these markets. So if we look at the bottom left, Russell 2000, you can see this is the second week in a row we're getting this yellow dot printed here. So that is notable. If we look at the top right, we now have the Nasdaq, which is printing its second yellow dot as well. And ACWX in the bottom right is printing also a yellow dot. The only of these 4 is the S&P 500, which is still green bullish trend. And so for those of you who have been following these videos for a while, I mean, you've heard me say it many, many times, but for anybody new, the way we think about this is when we get a yellow dot printed, it tells us that there are some cross currents occurring, that there are some mixed signals, that the trend is weakening. It doesn't mean we sell everything. It means that we want to just take a closer picture, closer look, maybe a tighter time frame to analyze what's really going on. We always sort of give the benefit of the doubt to the prior signal. And in all of these cases, the prior signal is bullish. It's higher. So we still want to give the benefit of the doubt to the buyers, but we want to be open-minded here that these long-term trends are starting to get into a more choppy sort of zone. And we haven't seen, a sell signal in any of these markets since last year, right at the start, coronavirus. Basically it signaled in the sell signal back in March of 2020. And the last week that it got out of it was basically late April, early May. I'm looking at the Russell 2000, depends what index you're looking at. So that's something to keep in mind. Let's take a look at the daily chart. Let's look at how these tighter time frames are going and looking. You can see that we do have a lot more mixed indecision here. The S&P 500, for instance, if we look at the top left, is all yellow here, and the prior signal is in fact a sell signal. So again, we have to be a little bit cautious here. I do think, and this is what's important here, is the opening takeaway here that I thought is that the sellers did fail to break us down, but I don't think we can sound the alarms and do victory laps here to the upside, because we haven't quite broken out yet, but we did not break down, right? So it's kind of the, glass half full, glass half empty, I guess, depends on how you want to look at it. But we're still in sort of this little choppy mess here in the S&P 500. Same thing for the Nasdaq. You can see it just started to get its act together basically Thursday, flipped from a sell signal to a neutral signal. So this is still in cautionary mode. Russell 2000 still in cautionary mode. You could argue right here, ACWX is the best looking of everything. International stocks looks the best out of all of the markets on a relative basis if you're looking simply at this trend filter, trend signal. So that's the way we're looking at this from a trend perspective. Let's take a look here at price action setup here, and let's take a little bit closer at what I mean by the victory that we had Tuesday and Wednesday. So I talked about this briefly in our trade ideas video yesterday, but essentially here we're looking at the S&P 500 on a daily chart. This was Tuesday's session right in here. So we had Monday, we opened up the week right in here. It's an inside day. And Tuesday we had a open near the highs of the session, and then we proceeded to sell off and close at the lows, kind of putting in a fairly sizable down session here on Tuesday. And then we opened up the session with this gap down, and the S&P 500 didn't get hit as hard as, say, the Nasdaq 100, which is where you could really see this illustrated. So here's Tuesday's session. You can see us close near the lows, and then we had this big gap down to start the day on Wednesday. Now, if this market really wanted to, basically stay heavy, if there were lots of motivated sellers, this was the perfect excuse to sort of break us down, to start to leg lower again, to take out the lows here from the 12th on Wednesday, May 12th, and start to leg us lower back down into, the low 300s here for the Qs. But we didn't get that. We got the exact opposite. We essentially just exhausted ourselves at the open with this gap down, and there were no more motivated sellers down here around 316. We got the exact opposite. We got buyers stepping in, driving this market higher, and then we got a gap up and follow through day here on Thursday. And now I'm stuck on the Qs still, so we'll just run the Qs analysis first. But we can also see that in this process here, we basically did take out this recent level here that we've been sort of contending with. So we had the lows kind of dancing around this, 326 area in early May. Then it found some resistance here, and then we kind of blasted through this on Thursday, and then we sold off a bit on Friday, right back to it. So for me, upper level line in the sand, here it is. If you want to see momentum stay in this market, then you want to see us above. It's a very, very tight level, and this is upper level momentum, but 326. If we can stay above 326 in the Qs, then, this train can keep on running to the upside, and we can get right back up here into the 340s. That would be a nice move and a great sort of change of pace here for the Nasdaq 100. Now, if we don't get that, if we come in on Monday and we gap down, or we lose this level, we start failing and kind of giving back the progress we made Wednesday and Thursday, then we're just back to this old choppy range here, and we have to be more defensive and a little more cautious and maybe a little more patient with the market if that sort of event, if that scenario sort of occurs. So that's the way I'm thinking about this. I think, again, that's the high level pro that happened in this market this week, was the fact that we failed to break down in a very clear attempt where we could have broken down, and now we're sort of waiting to see what kind of follow through can stem from that. If we look at the S&P 500, the difference here is there's kind of two differences. So one, S&P 500 did not break above this prior high here. So the high from the 14th, you can see we basically rallied into it and then sort of failed a little bit today. In other words, Thursday's follow through session didn't quite take out these prior highs. But if you take this on the other side of the coin here, we are much closer to, say, all-time highs. We're only less than 2% away in the SPY, whereas from all-time highs in the Qs, we are 4.5% away, let's call it. So a little bit of a trade-off, slightly different scenario there. I think, again, that speaks to sort of the relative strength we saw out of the Qs, and then generally speaking, over the past month or so, the S&P 500 has been holding up better, and it's much closer to highs. So that's really a tight level sort of look at what's going on here. Again, if you want to just take a step back and be a little bit wider and broader about the analysis here, we're still range bound, and that's it. That can be the headline too, right? If you don't want to look at the very, very small, intraday or day-to-day wiggles, right, then you just look at this and say, okay, we're still moving sideways. That's all I needed to know. Nasdaq 100, yep, still kind of in this broader sideways choppy range here. Nothing to see here until we start taking out highs or taking out these lows. Certainly another very reasonable way to look at it. All depends on your time frame, strategy, and so forth. If we look at the Russell 2000 here, again, speaking of sideways ranges, this is the king right now because it's really gone nowhere here for the past several months. And you can see it's just very much dead in the center of this range here. So nothing to see. Again, same comments though. Tuesday or Wednesday, we could have broke down here and start gapping lower, but we didn't. We rallied. We found some follow through Thursday. And then we gave a little bit back here, or we didn't in fact give any back, but we gave back some of the intraday progress on Friday's session. So that's sort of the recap there, and that's what we're looking at for the major markets. Let's take a look at a couple of others. Let's take a look at the dollar. The dollar here, you can see, as we talked about, it's continued to see its sell off. So it is back to its year-to-date lows. It's a little bit oversold. There's some MACD divergence, positive divergence going on here. So I'm not so sure we're just going to crash and burn and make new lows. I mean, it would fit the longer-term trend for sure, but we could be also just carving out, again, a broader range here in the dollar, and we might just be, at the low end of that range now that we can maybe even start looking at to see a dollar counter trend rally here. So keep an open mind, but we are back to sort of an inflection point. A lot of eyes will be on that 24 area. Again, this is the UUP. It's a dollar index, mostly euro basket currencies that it's measured against. But I think you get the idea here on, the US dollar just continuing to get debased and essentially be in a downtrend. So that's continuing here. If we look at TLT, not much else to say about this. I mean, we're still, like we mentioned in last week's video, kind of carving out maybe a bottom, or certainly at least just a sideways range in here. So it seems like it just wants to kind of go to sleep and move sideways. And then we talked about gold seeing some impressive moves. So this is what we highlighted here a few weeks ago. When we got the rally back up into here, we said, this is a good spot for it to fail because it's failed here in this channel multiple times. And, we kind of drew up the scenario. Well, if it fails in here, puts in a higher low, and then starts to move, then that could be an interesting way to play this broader pattern. But we didn't get that, right? In fact, we just got follow through and continuation. And you're seeing volume kind of come in here and stack up on consecutive green days. So I do think, this is something to pay attention to now. You're getting some structural breaks out of this down channel that it has been in, gold has been in for the past 10 months or so, and it is starting to move to the upside. You can see this, what it looks like on a monthly chart. It's not totally out of the woods yet, and it's still kind of a difficult chase, but got to give credit where the credit's due, and buyers are getting it done right here. So gold looks like it's going higher. I thought we could hesitate at this area. We did hesitate for just a couple of days, but then it was off to the races. So gold, I would not necessarily want to be selling it. I wouldn't necessarily want to be chasing it. My personal style, I would just be kind of waiting and watching. But I think definitely the buyers got the benefit of the doubt at this time. Let's finish off with some sectors and industries that stood out here. There were a handful on both sides. So we're going to kick things off here with the bullish side. Packaged foods. So packaged foods, pretty boring space. I don't know anybody that's going to get too excited over these types of stocks, but hey, sometimes the slow and steady stocks are easy to own and can, still generate nice trends and profits. So it's something to pay attention to. Doing well this week. You can see weekly chart here kind of closing at new highs, good volume coming in. So that was working. Beverages, so along the same lines, beverages, soft drinks, also working here, closing at new highs. Utilities, so a very boring list of things that were breaking out and holding up to new highs. Utilities up here, tobacco, working, right, closing at new highs as well. Semiconductors, not new highs, but we saw heavy volume come in and a close at the top end of the range here, kind of held these lows. So semiconductors is on this list. And then real estate here, this is more of a questionable one. The volume is what really almost triggered this onto this list, but the close near its highs, still very much an inside week, and wouldn't get super excited about this just yet, but it is notable in at least the fact that it was a high volume sort of inside week. If you look on the downside now, so some of the opposite things that are going on here. So airlines, not the worst pattern, not breaking down or making new lows, but certainly a heavier sort of rejection of highs here and closing at the lows. So a little bit of a different picture here versus, some of those defensive things we just looked at that are closing at highs. We got this thing closing at lows after trying to break out. So airlines pulling back. Auto, truck, and dealership, so heavy volume coming in, closing towards the lows here. Again, doesn't look horrible, but still looks on a relative basis a lot worse than some of those others. Education, now this looks more on the horrible side just because it has been selling off, continuing to sell off. This looks like it is, oversold for sure, but still in a pretty fierce downtrend and doing a lot worse than many other things. Lodging, looking a little suspect here, kind of getting back to the lower end of this range here. Some tails on the bottom, which could give some evidence of buyers stepping in here, but again, relative basis, pretty weak. Now, hotels and motels, so REITs. This is REITs, and we had well, I guess it wasn't. It was more of a real estate play in general up here in terms of this industry. So now this is REITs, specifically hotel and motel. So let's see what's in this 25 names. So it's a good list here that makes up this index. You can see some of the stocks there, but this was a bunch heavier this week onto the downside. And last but not least is steel. Steel for the second week in a row. We talked about this. It was on the list last week. So steel, we pointed this out. It hit this bearish scan, same thing, because it had this high volume kind of outside rejection week. And now we're getting some more follow through this week. So for the second week in a row, we're seeing steel in here. Still in a beautiful uptrend. Again, it's not something that I personally would want to be aggressively shorting, but let's look at price and volume. And right now we're seeing price and volume speak to us to the downside in the short term. So that's what we're seeing there in steel. So that's what I got for this week's video. Let me know, leave a comment below what stood out to you. What did you like? What are you paying attention to next week? I'd love to hear what everybody's looking at. So leave a comment below. And as always, I want to thank you for tuning in and listening and watching every week. Every Friday, we do these videos, long form market analysis, try to keep you up to date with what's going on out there. If you like these videos, give it a thumbs up, share it around, or if you got some feedback, leave a comment below. Love to hear feedback, constructive feedback, please. And if you got ways to improve it, things you want to see, always all ears on what everybody's interested in seeing on a week-to-week basis. So that's all I got. Thanks so much. Have a great weekend. We'll see you back here next week.